Hello everyone, my name is Temi. Welcome to my YouTube channel. In this video, I'm going to talk about Demystifying Certificate of Deposit, CD, a safe path to steady income. Let's dive in. CD, Certificate of Deposit, CD, is a type of savings account offered by banks. Generally, credit union offers similar product called share certificate, but some state chartered credit union also offer CDs. Both CDs and share certificate are low-risk deposit accounts that allow your money to grow at a fixed rate over a fixed time. They are similar in that they both require you to leave your money in an account for a selected time in exchange for higher rates, and you may face penalty if you withdraw earlier. However, there are key differences between the two. Number one, CDs pay out interest while share certificates pay out dividends. CDs are insured by the Federal Deposit Insurance Corporation, FDIC, while share certificates are insured by the National Credit Union Administration. Both CDs and share certificates are insured up to $250,000. CDs generally offer higher rates than regular savings accounts and money market, although the return may not be as high as what you will obtain in a stock market. CDs, however, offer significantly lower risk and predictable return than the stock market because of the fixed term and fixed interest rate. The compounding of CDs depends on the financial institution. Daily compounding and monthly compounding are more common, but compounding could also be annually and quarterly as well. The more frequently interest is compounded, the more the interest you earn. The frequency of compounding is reflected in the CD's annual percentage yield, APY, which is based on the assumption that you keep your money in the account until it matures. At maturity, you have two options. Number one, you can withdraw your money. You can start a new CD or you can invest in another financial product. Number two, you can roll over the CD with a similar term. However, the interest rate may not be exactly the same. So you want to do your due diligence about the interest rate before you roll over. Usually, rollover options are selected at the beginning of a CD term, but you have the option to terminate a CD within a grace period after it has rolled over. One of the best strategies for maximizing return in a CD is to develop a CD ladder. A CD ladder involves investing in multiple CDs with staggered maturity dates. It gives you access to your money at regular intervals when each CD matures. If the interest rate increases at maturity date, you can take advantage of it. There are two approaches to CD ladder. Number one, you cash out when each CD matures. Assuming you have $4,000 that you want to invest in CDs over 4 years, you can invest $1,000 in each of 1-year CD, 2-year CD, 3-year CD, and 4-year CD respectively. Each year, when a CD matures, you will cash out your money. The second approach, again, if you have $4,000 to invest, you can invest in 1-year CD, 2-year CD, 3-year CD, and 4-year CD respectively. But each year when a CD matures, you reinvest the money in a 4-year CD. So you keep reinvesting each time a CD matures. The major drawback of CDs and share certificates is the fixed term. Any withdrawal of the principal before the maturity date will result in early withdrawal penalty, EWP. The federal law requires banks to charge a minimum of 7 days worth of simple interest when you withdraw your principal. However, each institution may charge higher fee and apply them throughout the CD term. It is therefore important to check the account agreement for a bank-specific policies before you invest in CDs. When comparing CDs from different financial institutions, you want to consider the following factors. Number 1, interest rate. Different institutions have different rates for different CD terms. You may want to shop around and explore rates from different banks and credit unions instead of settling for the first CD you come across. Online tools like bankrate.com can help you search for the best interest rates. CD terms are generally in the increment of 3 months, between 3 months and 12 months. Thereafter, in the increment of 1 year until 5 years. However, some banks offer odd-term CDs like 11 months, 17 months, 18 months. Usually, longer terms yield higher rates. For example, the same financial institution may offer higher APY for 1 year CD than 3 year CD. However, 3 to 5 year CDs can have significantly lower rates. This is because banks may expect the Federal Reserve to cut interest rates. The decision between short-term and long-term CDs majorly depend on when you may need your money. Number 2, minimum deposits. Many banks require minimum deposits for CDs, while some do not. Most banks also have tiered APY for CDs, where low deposits will have lower APY and higher deposits will have higher APY. Number 3, early withdrawal penalty, EWP. Each institution is allowed to set its own EWP. While it is more advisable to select a CD term that allows with your financial goal to avoid early withdrawal penalty, it's important to select an institution that has a more friendly policy because of unforeseen circumstances that may cause you to withdraw from your CD before maturity. Some banks also offer no penalty CDs, but these generally have lower interest rate than CDs with penalties. Number 4, financial institution. It is important to consider the financial institution offering the CD. If an institution that offers the CD is covered by FDIC, your money is insured up to the $250,000 limit. So in the event that the bank fails, you will still get your money. The bottom line, CDs provide stability and a reliable way to grow your savings over time. In choosing a CD, it is important to research the institution's policy, especially the early withdrawal penalty. You want to choose the best CD that aligns with your goals and financial situation. Ultimately, with CDs, you can earn higher interest rates while taking on low risk. If you enjoyed this video, please don't forget to comment, like the video, share, and subscribe to my channel. Thank you. See you next time. Bye.